To fully grasp the magnitude of the credit crisis silently developing within the global monetary order, one must look beyond the surface-level metrics of major stock indexes and examine the structural fragile points embedded within commercial real estate debt. For over a decade following the global financial crisis, ultra-low interest rates and aggressive quantitative easing created a financial environment where capital was artificially cheap, driving commercial property valuations to unprecedented historical highs. Financial institutions, regional banks, and private credit funds poured trillions of dollars into office towers, retail complexes, and industrial assets, structuring these deals with heavy leverage and short-term debt maturities under the assumption that interest rates would remain perpetually suppressed. However, the aggressive monetary tightening cycle executed by central banks to combat persistent structural inflation has completely shattered this financial paradigm. As trillions of dollars in commercial mortgages approach their mandatory refinancing dates, property owners are encountering a brutal mathematical reality where borrowing costs have doubled or tripled, while property valuations have suffered catastrophic declines. This divergence is particularly severe in the office sector, where structural shifts in workforce dynamics and rising vacancy rates have permanently impaired the income-generating capacity of premier commercial real estate assets. When an asset's net operating income falls at the exact moment its debt service costs escalate, the underlying equity is rapidly wiped out, leaving property sponsors with no economic incentive to inject additional capital. Consequently, commercial property developers and institutional borrowers are increasingly choosing to hand back the keys to lenders through strategic defaults rather than refinancing at punitive interest rates. This wave of credit distress is not an isolated sectoral issue. It represents a systemic direct threat to the core balance sheets of the commercial and regional banking system. Unlike massive international investment banks that maintain highly diversified balance sheets and revenue streams, small and mid-sized regional banks carry an extraordinarily high concentration of commercial real estate debt relative to their total regulatory capital reserves. These regional financial institutions provided the primary engine for commercial real estate lending during the era of easy money, and they are now trapped with hundreds of billions of dollars in non-performing or under-collateralized loans that cannot be liquidated without triggering severe mark-to-market capital losses. As loan delinquencies rise and default rates climb toward levels last seen during major historical financial panics, the fractional reserve infrastructure supporting these regional institutions is exposed to extreme stress. When depositor confidence deteriorates, or when institutional liquidity flees low-yielding bank deposits in search of higher money market yields, banks face a classic duration mismatch and liquidity squeeze. As Ray Dalio has documented in his extensive studies of historical deleveraging cycles, when systemic leverage accumulates in illiquid physical assets financed through short-term paper debt, the inevitable contraction in credit velocity leads directly to systemic banking instability. The public narrative often treats commercial property distress as a localized corporate problem, but institutional capital allocators recognize that it represents the early stages of a broad credit crunch that will restrict capital availability across the entire real economy. When commercial banks are forced to set aside massive loss reserves to cover bad real estate loans, their regulatory lending capacity contracts dramatically, preventing them from extending fresh credit to businesses, consumer markets, and productive infrastructure. This credit engine freeze accelerates economic slowdowns, creating a dangerous feedback loop where declining economic activity further depresses property revenues and triggers additional loan defaults. Sovereign monetary authorities find themselves trapped in a severe policy dilemma, where keeping interest rates elevated to contain monetary inflation guarantees a cascading wave of structural bank insolvencies, while pivoting to aggressive interest rate cuts and liquidity bailouts risks reigniting structural inflation and further debasing the purchasing power of paper currency. Warren Buffett's fundamental principle of risk management stresses that excessive leverage combined with duration mismatches is the ultimate catalyst for financial ruin, and the commercial real estate debt wall represents the physical manifestation of this vulnerability across the global financial architecture. As this structural debt crisis continues to unfold, Understanding the transmission mechanism from commercial property defaults to bank balance sheet insolvencies is vital for any investor attempting to navigate the coming macroeconomic realignment. To analyze how this real estate crisis transfers directly into systemic banking vulnerability, one must examine the hidden mechanics of bank balance sheet accounting and regulatory capital requirements. When commercial banks issue long-term loans against commercial properties, those assets are listed on their books at face value, supported by fractional reserves and assumed property valuations. During periods of low interest rates and expanding liquidity, this accounting mechanism creates an illusion of perpetual stability. However, when commercial property values drop by 30 to 50% in major metropolitan markets, the collateral underpinning these multi-billion-dollar loan books is fundamentally impaired. Under standard regulatory frameworks, banks are not immediately forced to write down the value of these loans to current market prices as long as the borrower continues making interest payments. But as debt maturities arrive and borrowers find it mathematically impossible to refinance at current prevailing rates, banks are forced to recognize these unrealized losses directly on their balance sheets. This delayed recognition creates a hidden ocean of non-performing assets within the financial system, masking the true solvency profiles of dozens of regional lending institutions. As these losses are gradually recognized, a bank's Tier 1 capital ratio, the primary measure of its financial strength and ability to absorb shocks, erodes rapidly. When regulatory capital falls below mandated minimums, the bank must either raise fresh equity in an environment that is deeply hostile to regional financial institutions or drastically shrink its balance sheet by pulling back credit from the real economy. This structural credit contraction does not happen in a vacuum. It directly impacts small and medium-sized businesses that rely on regional bank credit lines for operational payrolls, inventory management, and capital expenditures. As credit availability dries up, corporate expansion halts, business bankruptcies increase, and economic growth decelerates sharply. This dynamic reflects Ray Dalio's framework regarding the self-reinforcing nature of debt contraction cycles, where falling asset values reduce borrowing capacity, which in turn reduces spending and investment, driving asset values even lower. Furthermore, the problem is severely compounded by the concentration of commercial real estate exposure within medium-sized banking institutions. While systemically important global megabanks have diversified their portfolios across international markets, consumer lines, and trading desks, regional institutions frequently hold upwards of 30 to 40% of their total asset base in commercial mortgages. A wave of defaults across office towers, suburban retail centers, and multifamily developments directly threatens the solvency of these institutions. When depositors realize that their local or regional bank is sitting on massive unrecorded real estate losses, capital flight accelerates. Modern digital banking infrastructure allows billions of dollars in deposits to move instantly out of vulnerable regional banks and into government money market funds or systemically important institutions perceived as too big to fail. This rapid drain of low-cost deposits forces troubled banks to rely on expensive wholesale funding or emergency liquidity facilities, further squeezing their net interest margins and accelerating their decline toward insolvency. Warren Buffett's insight that paper liabilities can vanish overnight while real debts remain constant is illustrated perfectly by this liquidity drain. As regional banks collapse or are forcibly merged into larger entities, the banking landscape becomes increasingly centralized, concentrating systemic risk into an even smaller number of mega institutions. This structural transition from distributed credit generation to centralized bank consolidation permanently alters the velocity of capital, restricting organic economic growth and forcing central monetary authorities to step in with ever larger bailouts and balance sheet expansions. The ongoing commercial real estate debt reset is not merely a temporary downturn in real estate cycles. It is the catalyst for a fundamental restructuring of the credit system that will redefine financial markets and wealth distribution for the decade ahead. The escalation of the commercial real estate debt crisis is now triggering a secondary wave of stress throughout non-bank financial intermediaries, commonly referred to as the shadow banking system. Over the past decade, regulatory reforms imposed on traditional commercial banks, inadvertently pushed a massive volume of real estate debt creation into private credit funds, commercial mortgage-backed securities markets, real estate investment trusts, and insurance company balance sheets. These non-bank entities, operating with far less regulatory oversight and lower liquidity buffers, aggressively financed high-risk commercial developments and leveraged property buyouts using short-term debt facilities and complex structured credit products. As commercial property valuations experience catastrophic declines and tenant default rates escalate, these private credit vehicles are facing severe liquidity bottlenecks and redemption freezes. Unlike traditional banks that can access emergency liquidity facilities from central monetary authorities during times of crisis, private credit funds and real estate investment trusts must rely strictly on available cash reserves or asset sales to satisfy investor redemption requests. When institutional investors rush to pull capital out of illiquid real estate funds simultaneously, fund managers are forced to halt redemptions or execute forced fire sales of prime property assets into a deeply depressed, illiquid market. These forced liquidations establish toxic price benchmarks for the entire commercial real estate sector, triggering further mark-to-market write-downs across commercial banks, pension funds, and sovereign wealth managers holding similar assets on their balance sheets. As Ray Dalio emphasizes in his structural analysis of credit cycles, shadow banking networks act as powerful leverage multipliers during economic expansions, but during deleveraging phases, their lack of a direct lender of last resort backstop creates catastrophic systemic liquidity gaps that quickly spill back into the primary banking system. Commercial banks maintain extensive indirect exposure to these private credit vehicles through total return swaps, warehouse credit lines, and derivative counterparty arrangements. When a major private credit fund or real estate investment vehicle collapses under the weight of non-performing commercial mortgages, the resulting counterparty losses hit the balance sheets of major financial institutions, threatening the stability of the interbank clearing system. Furthermore, insurance companies and public pension funds, which allocated trillions of dollars into commercial mortgage-backed securities to meet long-term yield obligations during the low-interest rate era, are now trapped with depreciating debt claims that impair their long-term solvency ratios. To compensate for these growing balance sheet losses, institutional asset managers are being forced to liquidate highly liquid paper assets, including corporate bonds and public equities, to maintain required regulatory capital ratios and meet margin calls. This cross-asset contagion mechanism transforms a localized commercial real estate debt problem into a broad financial market liquidity squeeze. Warren Buffett's fundamental principle regarding capital allocation states that risk comes from not knowing what you are doing, and the proliferation of opaque, highly leveraged credit instruments engineered by shadow banking institutions has created a web of hidden counterparty interdependencies that few market participants fully comprehend. As default rates on commercial debt instruments climb toward historic highs, the structural fragility of this shadow financial network is laid bare, forcing central monetary authorities into a corner where rescuing shadow banking entities requires unprecedented expansions of fiat currency creation. This inevitable monetary injection to backstop private credit market insolvencies accelerates currency debasement, destroying the real purchasing power of fixed-income paper assets and driving institutional capital out of credit markets and into unencumbered hard assets. The unfolding distress within non-bank financial intermediaries is not an isolated market correction. It is a critical transmission channel through which the commercial real estate debt wall triggers a broader systemic reallocation of global capital and wealth preservation strategies. As the structural credit contraction spreads from regional banks and shadow financial networks into the broader macroeconomic landscape, sovereign central banks face a fundamental dilemma that will define the next phase of the global monetary regime. For decades, central monetary authorities relied on a simple policy mechanism. Whenever systemic credit distress threatened the stability of the commercial banking framework, they aggressively lowered benchmark interest rates and injected massive liquidity into the financial system through asset purchasing programs. This intervention mechanism successfully contained short-term financial panics, but it achieved stability at the cost of expanding national debt burdens and systematically diluting the purchasing power of fiat currency. In the current economic environment, however, this traditional playbook encounters a structural roadblock. With national government debt levels reaching historical highs relative to gross domestic product and persistent structural inflation eroding consumer real incomes, central banks can no longer execute aggressive monetary bailouts without triggering severe inflationary feedback loops and massive currency devaluations. If monetary authorities choose to maintain elevated interest rates to defend the purchasing power of paper currency, the commercial real estate debt wall will inevitably trigger a cascading wave of bank insolvencies, corporate defaults, and severe contractions in real economic output. Conversely, if central banks capitulate to financial system distress by slashing borrowing costs and monetizing non-performing commercial loans, they risk permanently unanchoring inflation expectations and accelerating the global flight away from sovereign paper debt. As Ray Dalio's historical research on monetary cycles clearly demonstrates, when central banks are forced to choose between preserving the solvency of the financial system or protecting the purchasing power of the currency, they almost universally choose to sacrifice the currency through debt monetization and balance sheet expansion. Institutional capital allocators and global wealth managers recognize this policy trap, understanding that any short-term stabilization of commercial real estate and regional bank balance sheets will ultimately be funded through the invisible tax of currency debasement. When the monetary unit is systematically expanded to absorb bad debt claims, fixed-income paper instruments offering nominal yields below the true rate of monetary expansion become guaranteed vehicles for real wealth destruction. This realization is triggering a fundamental shift in portfolio strategy among sophisticated market participants. Rather than relying on traditional fixed-income bonds or cash equivalents for safety, institutional investors are reallocating capital into tangible productive assets, physical commodities, critical industrial supply chains, and non-dilutable reserve assets that carry zero counterparty risk. Warren Buffett's long-standing emphasis on owning inflation-resilient businesses with real pricing power aligns directly with this structural migration, as companies capable of adjusting their revenue streams to monetary expansion protect their real earning capacity while paper claims evaporate. Furthermore, the commercial real estate crisis is accelerating a geographic and institutional reallocation of global capital, moving liquidity out of financialized paper markets and into sovereign entities that maintain low debt-to-GDP ratios and robust asset-backed balance sheets. The commercial real estate debt reset is not merely a cyclical real estate downturn that can be resolved through conventional financial engineering. It represents the structural limit of a debt-fueled monetary model that relied on perpetual low interest rates to sustain artificial asset valuations. As this structural transition unfolds, the divergence between nominal paper returns and real purchasing power preservation will widen dramatically, reshaping the distribution of global wealth and establishing a new baseline for financial survival in an era of persistent monetary debasement. The final culmination of the commercial real estate debt wall marks the definitive end of a decades-long financial cycle built upon artificial leverage, suppressed capital costs, and expanding fiat balance sheets. As the cascading defaults across regional banking institutions, private credit networks, and corporate borrowers reach their peak, the structural illusion of paper wealth is dismantled, forcing a broad macroeconomic realignment across global asset markets. In this terminal phase of the credit contraction, capital does not simply vanish. It rapidly shifts from vulnerable financial claims into real, tangible assets capable of surviving systemic counterparty failures. The traditional allocation models that dominated institutional finance for 40 years are proving fundamentally inadequate in an environment characterized by persistent stagflationary pressures, structural debt monetization, and declining trust in financial intermediaries. Sophisticated wealth allocators are increasingly recognizing that holding nominal debt obligations issued by over-leveraged entities guarantees a real loss of purchasing power, even if nominal principal values are restored through emergency central bank liquidity injections. As Ray Dalio's framework on long-term debt cycles illustrates, when the debt burden relative to economic output becomes mathematically unpayable through organic growth, sovereign authorities inevitably resort to debt restructuring, yield curve control, and aggressive monetary creation to to prevent a complete collapse of the social and economic order. However, this unavoidable reliance on central bank balance sheet expansion to backstop commercial property losses and banking sector insolvencies creates a permanent regime shift in global capital preservation. When paper currency is degraded to absorb bad loans, the intrinsic valuation of scarce, unencumbered hard assets ranging from physical gold and productive agricultural land to critical industrial infrastructure and high-margin cash-flowing businesses surges in real monetary terms. Warren Buffett's timeless perspective on intrinsic value provides the ultimate compass for navigating this transition. True financial security is not found in complex financial engineering, speculative debt paper, or highly leveraged real estate schemes, but in owning productive, essential assets that possess pricing power, low capital intensity, and immunity to monetary debasement. As the commercial real estate crisis forces a structural consolidation of the banking sector, eliminating fragile regional lenders and centralizing credit issuance within systemically important state-backed institutions, the availability of free market credit will remain severely constrained for years to come. This enduring credit contraction will continue to suppress speculative real estate valuations while driving capital toward cash flow positive enterprises and sovereign reserves that maintain clean balance sheets. The commercial real estate debt wall was never an isolated sectoral glitch. It was the ultimate stress test that exposed the structural vulnerabilities of a global credit system operating at maximum leverage. Investors, institutions, and sovereign entities that accurately diagnose this structural shift, moving away from vulnerable paper claims and into resilient, intrinsic real wealth, will not only survive the fallout of this systemic banking realignment, but will emerge fully positioned to capture the greatest wealth transfer of the modern monetary era.